The holiday is over. The clock on student loan debt is now ticking. Did you know that student loan could be the golden key or hidden barrier to your dream home? The dream of homeownership is a milestone that many aspire to, but there's a growing shadow that's making this dream harder to achieve. Student loan debt in the US has surged, with borrowers now owing over $17 trillion. As a mortgage lender, I've seen firsthand how this debt impacts potential home buyers. In today's video, we're discussing the link between student loans and the real estate market. We'll uncover how student loan decisions can either pave the way to homeownership or create an unexpected roadblock. But don't worry, I've got some insider tips to navigate this maze. Stick around to the end because I'll be revealing some game-changing strategies that will help countless individuals turn their homeownership dreams into reality, even with student debt looming in the background. Hey there, welcome to our community. If you're new here, I want to extend a special welcome to you. We're thrilled to have you join us on this exciting journey. Our channel is all about mortgage, real estate, and the economies affecting both. I'm dedicated to bringing you the most insightful, actionable, and entertaining content out there. If you find value in today's video, do me a favor, hit the like button. It not only supports the channel, but it also helps me understand what content resonates with you the most. And if you haven't already, consider subscribing and turning on notifications. That way you won't miss out on any of the amazing content I've lined up for you. A huge thank you to our loyal subscribers for your continued support and feedback. Your engagement truly drives this channel forward. So before we dive in, drop a comment below letting us know where you're tuning in from and any suggestions you might have, anything you want me to talk about. We love hearing from you, and we often feature community questions in our upcoming videos. So thanks again for being here, and let's go ahead and get started. The dream of homeownership, a place to call your own, to build memories, to secure your future. But for many, there's a looming challenge that can make or break this dream. September 1st, a couple days ago, a significant month for millions of student loan borrowers. After a 3-year hiatus, the clock started ticking again. No more interest-free days. The first payments are due on October 1st, and the stakes are high. The housing market, as we know, is a delicate balance of supply and demand. And one of the significant factors that can tip this balance, financial obligations like student loan payments. With the pause on student loan payments coming to an end, many borrowers are finding themselves at the financial crossroads. That dream of homeownership, which once seemed within reach, might now feel like a distant mirage. The reality is, resumed student loan payments can significantly reduce disposable income. For many, especially those already on a tight budget, this added monthly expense can be a game changer. The dream of a new home might suddenly feel like an added weight, leading to hesitation and reconsideration. So what's the ripple effect? Well, potential home buyers grappling with these new payments might opt for their familiar rental, or they might choose to stay put, postponing that upgrade to a bigger home or a more desirable neighborhood. And here's where the broader housing market feels the impact. If a significant portion of potential home buyers adopts this wait-and-see approach, we could witness a dip in demand. And in a market that's been grappling with supply constraints, a reduced demand could bring some relief, potentially stabilizing prices and offering more choices to those still in the market. But it's not all gloom and doom. For those still keen on buying, this shift could present opportunities. Fewer competing offers, more time to make decisions, and potentially more negotiating power. In the ever-evolving landscape of real estate, external factors like student loan payments play a pivotal role. You see, as a mortgage lender, I've witnessed firsthand how student loan repayments can be a gateway or a barrier to home ownership. Making timely payments, especially now, can be your ticket to securing that dream home. So let's take a moment to talk about something that's often misunderstood, but it's absolutely vital when it comes to homeownership: your credit score. Now, you might be wondering, most people, of course, know it's important, but they don't really understand why. Why is it so important? Well, your credit score is like a financial report card, and trust me, lenders pay very close attention to it. It's actually like literally the first thing we do. Every time you make a timely payment on your student loans, credit cards, or any other debts, you're not just clearing a balance, you're building a reputation that tells lenders, hey, I'm responsible and I can be trusted to repay my debts. This positive financial behavior boosts your credit score, making you a more attractive candidate for a mortgage. So on the flip side, missed payments can have a detrimental effect. They can stay on your credit report for up to 7 years, and during this time, they can significantly lower your credit score. A lower score can lead to higher interest rates or even outright denial when you apply for a mortgage. So if homeownership is on your horizon, remember this: every payment you make is a step towards building a solid credit foundation. And in the world of real estate, a good credit score will help you secure your dream home at the best possible terms. In essence, by staying on top of your student loan payments and any others, you're not just safeguarding your financial future, you're paving the way to unlocking the doors of your dream home. So prioritize those payments, nurture your credit score, and watch as the path to homeownership becomes smoother and more accessible. In the US, a typical student loan payment hovers around $400 a month. This significant monthly obligation can pose a real challenge, especially for those already navigating tight financial constraints. Imagine allocating such a substantial portion of your income every month and the strain it can place on your essential expenses. What's even more concerning is that for a notable segment of the borrowers, this debt has been accumulated without the completion of a degree. The absence of a degree often means missing out on the enhanced earning potential that higher educations typically offer. This scenario can lead to a double-edged sword: rising debt without anticipated increase of income to offset it. Beyond the tangible financial implications, there's an emotional and psychological toll that cannot be ignored. Facing what feels like an insurmountable mountain of debt can lead to feelings of overwhelm, stress, and even hopelessness. However, it's essential to remember that there are avenues for assistance. Numerous resources and programs are available to help borrowers manage, reduce, or even defer their payments. Exploring these options can provide a much-needed relief and a clear path forward amidst the complexity of all the student loan repayments that you'll have. This is a channel focused on real estate and mortgages, but I think it's incredibly important that we let as many people know about the options that are out there. There are more folks that we know, and the more people we help, we can keep them from going delinquent. And that's part of what this goal is as my channel. Let's help as many people as we can. All right, let's dive into some of the changes the U.S. Department of Education is bringing to the table to support student loan borrowers. All right, first up, there's a significant amendment to the Repay plan, which many of you might know as Revised Pay as You Earn plan. But here's the twist: it may soon be referred to as the SAVE plan, short for Saving on a Valuable Education. Pretty fitting name. Now, if you've ever felt overwhelmed by the myriad of repayment options out there, you're not alone. The good news is the department has streamlined these into 3 primary categories: fixed payment plans, income-driven payment plans, and the alternative repayment plan. This last one especially is tailored for those with unique circumstances or for those who might have missed out on providing some crucial information. All right, here's where it gets even better. The new regulations are designed to cast a more robust safety net for borrowers. Think of it as a financial cushion, ensuring you don't fall into the pitfalls of delinquency or default. Especially for our low and middle income borrowers, this means a more feasible path to managing federal loan payments. And yes, even dreams like homeownership, nurturing retirement, savings, or kickstarting a small business. Diving deeper into the major provisions, we're looking to expand access to manageable monthly direct loan payments, more consistent definitions across loan programs, recalibration of the income exemptions for repayment calculations, the goal to ensure that you're not stretching every dollar too thin. And come July 1st, 2024, a new plan and even more restrictions coming out for more opportunities for enrollment. In essence, these changes are a beacon of hope, offering a more streamlined, transparent, and affordable repayment avenue. The ultimate goal is to ensure that every borrower has a fighting chance against delinquency and default. All right, let's address something pretty crucial. As student loan borrowers gear up to resume their payments, there's an alarming trend we need to be very wary of: the rise of debt relief scams. These scammers often promise to reduce or even eliminate student loan debt, but here's the catch. They demand hefty fees up front, and after pocketing your hard-earned money, they vanish, leaving you with the same debt and an even lighter wallet. As mentioned, there's a silver lining. The Attorney General is championing the SAVE plan, aiming to provide genuine relief to borrowers. This initiative is designed to guide students through the repayment process, ensuring they're equipped with accurate information and legitimate resources. So here's the takeaway. Always be cautious. If an offer sounds too good to be true, it probably is. Before making any decision, do your research, consult trusted resources, and remember that official student loan services will never, ever ask for fees up front. Stay informed, stay vigilant, and let's protect ourselves from these financial predators. All right, I promised some knowledge, some expert advice, some insider information on navigating the student loan payments, so let's just jump right in. Starting with conventional loans, if your student loans are deferred or in forbearance, lenders typically will calculate 1% of the outstanding balance. Some will do 0.5% of the total balance for your payment. And why? It may or may not make a difference to you, but for you individually, it could change some of the guidelines to get your loan approved. Fannie Mae and Freddie Mac have very similar guidelines, but there are many nuances. Depending upon your situation will depend on what avenue your lender/broker goes through. So pay attention to that. It could help you determine what sort of documentation may or may not be needed. That's one of the insider tips. Now let's talk about the next one. All right, here's a big one. The insider tip of this entire video. If you're close on DTI and you need to get your debt to income ratio down, and by reducing your liabilities, you can take advantage of an income-based repayment plan. Lenders will use the new monthly payment on your paperwork as long as it covers at least the interest accrued each month. Insider tip. Next up, FHA loans. For deferred student loans, FHA guidelines require lenders to use either 1% of the outstanding balance or the monthly payment reported on your credit, whichever is greater. If you're on an income-based repayment plan, the monthly payment on your credit report is used, but there is a catch. Again, it must be at least 1% of the loan balance. If it's less, then the lender will use that 1% figure. Lastly, VA loans. Designed specifically for our veterans. If your student loans are deferred for 12 months or more, the lender will not consider it in your debt to income ratio. But if it's less than 12 months, the lender will use 5% of the outstanding balance divided by 12 for your monthly payment. For those income-based repayment plans, the actual monthly payment reported on your credit report will be used as long as it's not zero. In summary, while the dream of homeownership is exciting, understanding how your student loans impact your mortgage options are crucial. Whether it's a conventional, FHA, or VA, being informed helps you make the best choice for your financial future. And that, folks, wraps it up of our deep dive into the world of home loans and the impact of student loans on our mortgage options. I hope you truly enjoyed the information that empowers you on your homeownership journey. If you found this video insightful, please give us a thumbs up. And don't forget to hit the subscribe button. Stay updated with more valuable insights by following along on our channels. Feeling ready to take the next step? Head over to www.applydarrenhunter to complete your application. Our team is here to guide you every step of the way. Thank you so much for joining us today. Remember, knowledge is power, and we're here to equip you with all the tools you need. Until next time, this was a guaranteed video with guaranteed information. Have a great day. Take care.